Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. For us to bring you the best information out there, there has to be information to give you. During the last couple of weeks where I've been on vacation, a lot of things have been happening, and as everyone knows, inflation being what it is, the economy being what it is, the prognostications that we had earlier in the year have fallen flat. Once again, fallen flat, and this is a recurring theme. It's a good thing for some, not such a good thing for others, meaning that I'm not the only one out there predicting certain things that don't happen, i.e. the recession. Is it coming? Is it not coming? We look to the economic indicators, we look to the people who talk about it, we look to the housing market, we look to the lenders market. What we're seeing is simply rates are going up still, and the housing inventory is not as good as we would like it to be, meaning that we don't have as many houses on the market today that we did a year ago. Sales have suffered some in some parts of the country. Prices have continued to rise, while in other parts of the country, prices have not. What we do see and what we want to see are two different things. Anyway, I am Jeff Barton. This is The Mortgage Voice, and thank you very much. If you want to see us, go to YouTube. Jeff Barton, The Mortgage Voice is on YouTube, and you can see us there every week. We have hundreds of shows from the past where you can call me out and say that I was wrong on that particular date, which is fine. It shows that you're interested, and this kind of information is always fluid, always in flux, and always has different points of view. I have several points of view of my own in terms of what's happening in the housing market, but let's just get through a few things. Again, I'm Jeff Barton. This is The Mortgage Voice. All right, let's get to rates. Rates are always the thing that people look at most, although since we have now adjusted to the higher interest rates, 7% doesn't seem all that much. If last year, a year ago, from right now, we were at 6%, 7% doesn't seem so bad. If you have a long memory, and in today's world, 3 years is a long memory, when interest rates were 3%, 3.5%, yeah, it's really quite a shock. But since we are in this market, it's okay to have 7% interest rate, which is kind of where we are today. Let's see, 30-year interest rate, 7.04%, 15 years at 6.40%, the FHA is at 6.64%, the jumbo is at 7.02%, and 6.96 is the 5-1 ARM. I always talk about that 5-1 ARM. Back in the day, now I say back in the day before COVID, right, when I could pretty much regularly know where rates for certain products were going to be and how we were going to get to the next level up or the next level down. Today, I can't say that, i.e. the 5-1 ARM is at 6.96. We used to have this as a, it's an adjustable rate product, and because of that, we usually get a lower introductory rate to get you into the loan, either a 2, 3, 5-year loan, and then it adjusts after that, and that adjustable rate is what people used to be so worried about. Well, today, the adjustable rate advantage to get into something where you could actually afford the payment and you were deciding whether to keep it or move on, sell the property, whatever you're going to do to keep a rate or to get a better rate, it doesn't apply because this at 6.96% of the 5-1 ARM is the same as the 30-year at 7.04. What's the difference? If you can lock in your payment for 30 years at 7%, why would you go to an adjustable after 2, 3, 5 years at 6.96? Makes no sense. The reason being, there's risk in that 5-1 ARM. People don't like ARM products. People tend to not pay them off as quickly as they do or as surely as they do the 30-year product. So the lenders don't like it, therefore it's priced like this. It's not unlike the bond market, where we've been the upside-down world for at least the last 12 to 18 months. What do I mean by that? Everybody who listens to this show knows that we look at the 10-year. The 10-year Treasury note today is trading at 3.863, 3.9, let's say. What does that mean? It means that if you want to buy U.S. debt, this is what you're going to get paid for the bond that you hold. Now, U.S. debt is selling cheaply, and you're getting paid handsomely on the 10-year. But that doesn't mean anything because the 2-year, you're actually getting more. So why would you invest in the 10-year when you can invest in the 2-year and get more? Why would you do that? You're more liquid after 2 years to make better decisions. We're seeing 2 years right now. What's going to happen in the real estate market? I guarantee you the real estate market is going to come down at some point in terms of the cost, the price, and all of that leads me into the reason why, but I won't get into that quite yet. Let's see. So the 2 years at 4.9. The 10 years at 3.863, that's about a 100 basis point spread between the two, which always portends that recession. Currently, the recession talk is muted. Why? Because we have the economy at 1.7% GDP in the last quarter. We see all kinds of things going on which indicate that the economy is doing pretty well. Employment, doing pretty well. Inflation, really down. I saw a figure today at 3.7%. We seem to be in that realm. Fed raising another 25 basis points. Are we going to see that again in September? I'm not quite sure. What the policymakers want to do either at the Fed or at Treasury is to walk the fine line. We have that election coming up, so Uncle Joe over there, whether he gets indicted or not, who the heck knows, politics being what they are, we would like to see a steady hand at the Fed and an optimistic approach, i.e., less of raising of Fed rates, and therefore we would see an extension of the good economy we still have, even though all of this other stuff has been going on. Okay, let's get to some more news to use. Fed rates up 25%. I said 25%, 25 basis point. And let's see, the inflation, 4.7, as I said. GDP is at 1.7, as I said. We did have a UPS strike averted. That was a big thing. You know, labor in this particular economy, and labor's really gotten a bad name over the last, 10, 15 years. It's always us versus them, and, the big bad unions attacking the little guy and making it harder and driving prices up. Well, none of that's really in play. When a company like UPS moves stuff from you to me, from me to you, from where you bought it to like Amazon. Amazon's also going to have these same contract negotiations, as is FedEx, as is, any number of other carriers out there. That particular strike to be averted is a good thing for you, even though prices will probably go up. UPS spokesman today was talking about $30 billion in the next 5 years more will be spent on the employees that work there than had been spent in the previous 5 years. It's a good thing for the employees, but yes, prices will go up. Now, some of the inflation numbers that we see are a matter of business. Contract negotiations with the union workers get more money. Obviously, the company has to raise prices. That is a normal state of inflation. However, $5.62 at the pump today, that is not a normal state of inflation. And I say that because, and I've always harped on this gas thing. In California, we refine our own gas. We pump our own oil. This is a domestic issue here for California, yet we are still seeing prices at the pump as if we're seeing $140 a barrel of gas, a barrel of oil. That's not what we're seeing. We're ranging between $70 and $80 for the past 12 months. So where is this price increase coming from? That is not inflation. That is greed. Two different things out there in the world of how we do it. Now, I talk about all this stuff because it affects housing. It affects your ability to be able to go out there and get a loan for more than you might expect because the payments are less or the payments are more. Now, we've seen with the interest rate go up, obviously the payment on your particular mortgage is going to be higher because the rate is higher. But if it is eaten up by non-inflationary greed-based price hikes, obviously that amount of money that you're spending in gas on a weekly, on a monthly, is taking away from money you might be able to spend on your house. Now, one of the good things that we've seen, we got about a minute left and I'll rush through this a little bit, new home purchases. Now, in the new home purchase world, what we've seen is, as a result of less product on the market, people who are buying newer homes. It's a trend. 25% of the buyers out there right now in the U.S. are buying new homes at these particular prices. Now, as with all new home buyers in the U.S., whether it's D.R. Horton, Lennar, KB, Shea, Broad, Pulte, Taylor Morrison, or Meritage Homes. There's a whole bunch of them out there. They're all offering incentives. They all want you to get them into their home. They all offer you financing. Anyway, that's where we are in the housing market right now. I'll be right back. I'm Jeff Barton, your voice in the mortgage industry, and stay tuned.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. You know, we've been on the air for about 9 years. KCAA handles our signal out in the San Bernardino Riverside counties. I love what they do. They bring us to you. You're driving around on a Saturday or a Sunday. Either you're coming from church or you're from the Home Depot, wherever it is, trying to do some projects, figuring out how you're going to finance that next project, or at least talk about real estate. This is a great, safe place where you can listen, take our advice, or at least use it to your best advantage to be able to understand what's happening in the mortgage markets and in the real estate markets, whether it's on a worldwide basis or whether it's just locally right there in San Bernardino Riverside. One of the things that we talk about on the show is speculation in real estate, whether it's building and selling, whether it's flipping. With us right now is Josh Thompson, who is from Malibu Funding, who's really in that business, one of the experts that we bring on from time to talk about it. Josh, how are you?
I'm doing great, Jeff. How are you?
I'm fine, thank you. Okay, so crazy market as always, but we have seen rates really stay between 6.5% and 7%, probably over the last 6 months. It's been in that range, don't you think?
Yeah, I would agree with that, yeah.
Okay, and in terms of the rates themselves and how it might affect buyers, I know that you're currently in building on a couple of different projects. When you're starting to pencil out what you're doing in the building world versus the reality of what happens at the end when they're finished, what kind of difference, what kind of space do you leave so if something goes bad, you still are able to get out, or at least get out with a little bit of money?
Yeah. I mean, I think, what's good with a lot of these, lenders that I secure financing with and all that stuff, construction lenders, they always give you a 25% margin between like what the after repair value is at that time, of getting your construction financing, versus what your construction loan amount can be. So that's pretty much a good gauge, right? You don't want to be too highly levered at the point that something does happen with a decline in the market and then you can't exit. So that's always pretty much a good gauge for me, and having at least like a 15 to 20% margin. But of course, also looking for margins much higher than that. But I would say a 15 to 20% margin on costs should always be there, just in case there is like a 5 to 10% decline in the market and you do need to exit. I also like to do like a back of the envelope kind of underwrite on my own projects to make sure that if I can't sell it, if there's some catastrophic event in the market in terms of market values for sale, then at least it still pencils out as a rental, and I'll be able to kind of service the debt on the property if I need to refinance it and hold it as a rental until, things kind of come back up again. So I think if it makes sense as a rental, on the back of the envelope underwrite, then it's pretty safe.
No, I like both of those things, and the experience that you have in terms of, building these projects has obviously brought you to the place where you're comfortable at your own, foreseeable, what's happening out there in the marketplace. In terms of what's happening in this marketplace, where we've seen, obviously the rates rise for the end consumer, what exactly are you looking at when you're deciding on a project in terms of both the financing and the availability of like, for instance, if we have, as you said, a catastrophic event and the borrowers go bye-bye and you're unable to sell it, how far in advance do you look? Is it 18 months to build the house, 8 months, 10 months, 2 years? What kind of time frame are you into that?
Yeah. And I mean, it depends too on what kind of project and what you're doing. Like definitely on a ground up project, and depending on what local municipality you're doing the project in, right? Like, so,
Right.
The project I'm doing out in Joshua Tree, took a little bit over a year. They're pretty quick on planning, so it's not, and, there's no real hiccups on that one. But, looking at something in like LA or, Inglewood is that one that we've talked about over the years that's still ongoing.
Right.
In a place like that, you need to really, no one has a crystal ball, but, entitlement process in somewhere that's like a more densely populated area can take anywhere from 1 to 3 years in some cases, depending on exactly what you're doing and what you're building.
So it's a real crapshoot a lot of times when you're just trying to do these infill deals as to what the market's going to be, because it sounds like more municipality interference than it does actually market interference.
Oh yeah, that is correct. Yeah, it's much more municipality interference than market interference, and it's really sad, because we are, I think the government has a duty to help produce housing for the people, and everything that you keep hearing is like we have interest rates that are double or triple what they were a few years ago. And we actually still have, home values increasing in the United States of America because there's a lack of inventory.
Right.
So we just keep hearing this lack of inventory phrase for the last 10 to 15 years, and it's like, what is going to change that? And I think loosening up regulations and and not even loosening regulations in a sense of something that's going to be harmful for consumers, but there does need to be some sort of revision or expediting process to this so we can actually kind of balance out the supply and demand for new housing in the country.
What happens always, and since '08, okay, so most of the builders just stopped building the way they were building, right? I mean, '04, '05, and '06, man, it was just rolling tracks out, whether it was in Salt Lake, whether it's in Vegas, whether it's down in Miami. I mean, people were just building like crazy. Well, they got burned, right? The Great Recession, all these companies lost a ton of dough. They just pulled back and stopped investing in building housing. Right now in the U.S., there is a boom in building. I don't know, a lot of people don't know that, but new home building is, really doing well. So you're supplying the one house, whereas the big builders are supplying the many houses. But to catch up, I mean, you think about that. It stopped in '08, and today is 23. Well, that's, 12, 13 years of housing that didn't get built. So it's going to be a while.
Yeah, and the way to catch it up is, I mean, the 20 houses I'm doing in Inglewood. I mean, that was the toughest entitlement process I've ever encountered.
Right.
That's the largest project I've ever done. Oh, it's not finished yet, but it's just the hoops that we had to jump through to be able to get that approved, and kind of special variances that needed to be applied for, and then the time frame on the responses. I mean, it's crazy. I mean, what was on the existing site when I bought the land, there were 11 units there across, different properties. So we're increasing the density by, close to, 100% or doubling it. But it's ridiculous. I mean, it's very difficult to bring new housing to the market. So I do think there needs to be some refining of that process, just so there can be some sort of halfway point for developers and governments that kind of help the consumer. Because theoretically, with the rise in interest rates, we should be seeing more of a decline in property values, right? And that would be helpful for the consumer. And I think that's what the Fed's mission is with the rate hikes, and to actually see the adverse of that. At least it's now at a more manageable pace, I guess, of home values rising. But based on where we were during the pandemic, that was like a once in a lifetime phenomena of just crazy, inflation on home values that we would actually. I think most people would be okay with seeing like a decline in values over the next few years, just to kind of catch things up. So that's another point.
Well, certainly anybody who has a 3% mortgage is fine with it. But if you got a 7% mortgage and you just bought last year, you don't want to see it go down. You just don't.
Well, no, exactly now. Yes, that's correct.
Okay.
Correct.
Hey, listen, I talk about this all day because it fascinates me all the time, and there's no consensus. All you get is a politicalization of whatever the issue is, as opposed to no. This is all these things are important to the consumer because the choice that they have is don't buy and rent, which is going up and expensive, or pay these exorbitant fees because we can't build more houses. It's just wrong, my opinion.
Yeah, I agree.
Hey, you want to shout out a phone number by which people can get a hold of you? This is Josh Thompson. He's a builder, flipper, works for Malibu Funding. Go.
Yeah, my number is 323-945-5694, and give me a call anytime.
Excellent. Thank you very much, Josh. Appreciate you coming on the show. I really do.
Thank you, Jeff.
You're welcome. That's Josh Thompson. He is a builder extraordinaire as well as a terrific loan officer, real estate agent. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. We bring to you local and national issues that we try to point out what is important to you as the consumer who's trying to get a loan just to get a house. Whether it's the rate, which is really determined by the bond market, as everyone knows, but also the Fed raising rates doesn't help either in terms of the rate. Also on local products, a lot of non-QM being done right now, a lot of all cash buyers still in the marketplace. There's many things to talk about, to bring to you from us. Brenda Scott joins us once again. She's a loan officer for Malibu Funding. Terrific loan officer, really knows the business, been around a long time. Brenda, how are you?
I am good. How about yourself?
I'm okay. Thank you very much. And I say okay because it's sweltering out there. Oh, my gosh.
Oh, yes, it is. Yes, it is. I hate the summer. I don't like summer at all. That's my least favorite season.
Okay. Do you melt or do you just get tired?
I just burn.
Oh, I see. Okay. That's one I hadn't thought of. Okay. All right. So, speaking of things that are hot, obviously this is a stupid segue. The real estate market has been hot, although right now I'm not quite sure where we are. Give us an idea of what's happening in the mortgage market and the real estate market in general in the area that you work.
You know what? I know rates are high, and I know that's what you hear all the time, but this is still an excellent time to sell. It's an excellent time to buy. There's a lot of good programs out there, and they're not permanent programs. They're, within 3 to 5 years, and then you can turn around and you can refi, but it's still a good market.
Okay, give us an idea of one or two of these programs that you're talking about, whether it's a non-QM or whether it's a standard program, some hybrid.
Well, we got 100% financing, where you have a 90% or 80% first, 20% second, and those are still good programs. I mean, I remember when I bought my house years ago. I bought my house on an 80-20. And it was excellent.
Explain how that works and what the procedure is to get one of those loans.
Well, you got to have a pretty decent FICO score. The higher your FICO score, obviously, the better your rate. So you got to have somewhere close. The better the FICO score is between 7 and 720.
Okay.
Those are good FICO scores for that. And then you got a first where you make your payments, and sometimes these lenders are offering interest only for 10 years. And on that second, it's just a standalone second. And some of the lenders even offer, if you keep it for a certain amount of, like, say, 6 months, you can refinance that. You don't, and there's no prepaid penalty on them at all.
Okay. So, this is strictly for purchase, or is this for investment properties? What is it for?
It could be for investment properties, too.
So getting into a property is really dependent. Obviously, you have to have the income, but it's really FICO score or credit score driven.
It is FICO score driven, absolutely. Because you think about it, you're not putting any money down. So the lender is really taking that risk. So you got to have some kind of, your credit got to be impeccable. and you have to debt service that mortgage.
Okay, so okay, right, exactly. So this is the type of loan that you can either do for a DSCR loan, debt service?
You can do that too. You
Okay.
can do a DSCR. Those are very good loans for non-owner occupied. I mean, you can get in that with 20% down, and that's it. All you got to do is make sure that mortgage covers that mortgage payment.
Let's talk a little bit about FHA. Do you do FHA, and what kind of products are the standard FHA? Okay.
I just closed a 100% VA. VA got good pricing right now,
Okay.
and I'm going to tell you something else. The agent that I'm working with, or that I worked with, I mean, he negotiated a good thing where the buyer didn't have to come out of her pocket with any money. It was the seller gave a very nice credit that covered all the closing costs on it.
Oh, that's excellent. Now, I know FHA can go up to, what, 9%, or is it more in terms of credit from the seller? Is it 9%?
Yes. That's still a good deal.
Yes, it is.
I mean, you got a purchase going on, and the seller is willing to give you a $10,000 or $15,000 credit.
Yep.
You're in. That is, and there's no skin off of them because they have the prices higher anyway, and they are already aware that this is a market where you have to give credits to buyers now.
What do you see about the market? Do you think it's a good real estate market, i.e. prices going up and there's enough properties for people to be able to buy, or is it the other way around?
No, I think it's still a shortage. I think it's still a shortage of properties.
Oh, I think that too, yes.
That's why I say if you don't wait. I mean, I have people saying, yeah, I'm ready, Brenda, but the rates are high. Yeah, but when you get ready, guess what happens?
Prices are up.
That prices is going to be up.
Right.
So you got 6 in one hand and half a dozen in another, and just go for it instead of just paying rent.
Now, so many of the loans that we do, we have to make sure that the borrower, all loans that we have to do, we have to make sure that the borrower can repay the loan. Are you seeing any cracks in the employment in the area, i.e., are people getting nervous that there might be a recession? We've been talking about it now for over a year. It's coming. I'm not sure whether it is, but is this affecting the market at all in terms of buyers you represent?
No, because, I tell you what the lenders are doing, and I really tell the client, when you get ready to buy or refinance, don't use your credit.
Right. Like, don't buy a car, don't buy anything on top. Right.
Don't buy anything like that. And when the lender ready to close that loan, they're going to verify your employment. That is the one thing. And they're going to have you sign this document that says your employment is a continual employer. So they're going to make sure that you have that job, and that job and continuous.
During times like this where we see a rapid rise in both the rate and really the price of the houses, we get a lot of nervous lenders, and they've pulled back or made some of the programs a little bit more difficult to apply for and to get qualified for, just simply because they're nervous about the market.
Yes.
Do you see in your world? Do you see that changing? Do you see that loosening in anytime soon?
I do see it changing, Jeff.
Okay.
That's why it goes right back to the FICO score.
Okay.
If your FICO score is low, it's not going to be as attractive as it is if you have a 700 or a 720 FICO score. They're looking for the prime on those because they want to see that you have the ability to repay that loan back.
Right. Of course, it's part of the.
You can have non-occupant borrowers to help you qualify for that loan.
Well, which is a great thing. Obviously, income is the issue. FICO score gets you in the door. So if you have to add people into your income, is it a blended FICO score, or do they take the worst FICO score?
They take the worst FICO score. So let's say if you have a daughter or son that wants to buy, and the parents are going to be the non-occupant borrower, and the income is there, but the kids have the FICO score, that's still a good deal.
Mm-hmm.
That's an awesome deal.
Okay.
And some lenders will do a blended FICO score too.
all of these is great stuff. Could you let people know how to get in touch with you, Brenda Scott, a terrific loan officer here in the Southern California area?
Yes, I can be reached at 562-500-2400. Again, that's 562-500-2400. Call me. Doesn't cost you anything.
Okay, excellent. Now, I know you have, it's your son, yes?
Yes, I have a 17-year-old.
Okay, how's summer going?
I hate summer. We eat all day. I have a higher grocery bill, higher electricity bill. I can't wait till he go back to school.
Is he sitting in the car with you?
Absolutely.
Well, stay cool, and I know that you love your son very, very much.
Yeah, he's getting ready to drive. Did I tell you that?
Oh my gosh, that's a whole thing that everybody. Yeah, I've done it. I trained 3 kids on a car. I know. Unbelievable, Brenda. Thanks very much for coming on the show. I always appreciate it.
All right, honey. Have a good one. Talk to you soon.
You too. Brenda Scott, Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show to listen to what we have to say about local issues that might affect your decision about which kind of rate you want, what kind of loan program you want. Do I really want to buy that house over there, or do I want to buy the house over there? Now, of course, that's a generalized look at what's going on in the market, but it is what we do each and every week and have been doing it for about 9 or 10 years. If you want to see us, go to YouTube. Jeff Barton, the Mortgage Voice, is on YouTube. Hundreds of shows there, and you can see the pattern and the trend lines of what we've been talking about for, well over a year. That is, interest rates have gone up, and they've really made buying a home a little bit more difficult, a lot more difficult for some people who are don't have great FICO score and other necessities like ability to repay. However, there are programs out there, and to talk about a little bit about what's going on in the program world for Malibu Funding is Jennifer Conrad. She joins us now. Jennifer, how are you?
I'm well, Jeff. Thank you so much for having me back.
And thank you very much for coming on. You're one of the most knowledgeable people in the industry with the experience to back it up. Tell us a little bit about what is happening in the mortgage world. I mean, are we seeing a lessening or a contraction in terms of funds available at the bank? Are we seeing expansion? Are we seeing credit standards lower? Where are we?
Well, I would say that I am seeing that some of the credit standards are a little bit higher. I was actually just inquiring in regards to a program that I've used quite a few times, which is a stated income verified asset for a primary and secondary home. Okay. And I was used to the credit score being a 640, and the lender just told me now they raised it to a 680. So I was like surprised to hear about that. But yeah, So I'm starting to see that a lot of lenders are asking for scores to be a little bit higher, even with some of the down payment assistance programs where we thought, maybe it was going to be more like a 620. It's like they're raising it to a 640.
Okay, what does that do? How many borrowers get knocked out when you raise something like that, 40 points? To me, it's a lot, but what do you think?
It is a lot,
right.
And
it is.
Unfortunately, it seems like a lot of potential buyers are having more credit challenges right now. It feels like a lot of people are still trying to recover from losing jobs during COVID, just having their income reduced. And even though they may have been given opportunities to sort of be in a forbearance or a deferment, now they're trying to play catch up. And so some people are still affected. So, yeah, scores are down. Now,
I saw in an article I read that over the last 2 years, $5.5 trillion in savings has been spent by the American consumer. I think when the reserves are obvious as that going down, right, that it affects the market in general. Like you say, FICO scores are up because they want to make sure that people have a track record of paying their bills off. It makes sense, but it does inhibit people from buying. You yourself, in the housing market, you know what I'm talking about.
Yeah, it does. I mean, I think there are some opportunities where, people can maybe do a buy down. I think a lot of lenders are offering options to be able to do that. So you can sort of buy down the rate. And then I'm seeing, obviously we're asking for sellers to offer money towards closing cost assistance to give buyers an opportunity to do that, to try to qualify, especially, like you said, since rates are going up. But it does seem like, people have to buy a little bit less house, or in some cases they are still renting, just kind of hoping that they would be able to qualify with the buy down and be able to see if they can get something.
Do you see that product as popular? We talk every other week to somebody who's talking it up, and then I'm not sure I see many people asking for it. I mean, I have a lot of loan officers that call me, and very rarely do they talk about the buy down. Was it in vogue? Now it's out of vogue?
I think a lot of people are interested in it, but I also think because we don't really have lenders giving a lot of training regarding it, I think people kind of, steer away from it because you don't really want to go out and try to sell something that you're not really sure how to do. But I think if we're in a situation where sellers are willing to offer money in order for the borrowers to be able to buy down their rate, then it makes sense. But the question becomes, how often will we get that? I'm not seeing too many purchases where we're getting closing cost assistance right now.
Right. FHA, obviously, it's more common because that's part of the FHA attraction, right? The seller can give a certain number of points back to the borrower for closing costs. But in a traditional mortgage or a conforming loan, it's not as straightforward. So really, you have to have great education in that buy-down program.
That's very true. Yeah. But I'm even noticing with the FHAs, we're just not getting, much closing cost assistance. I think, for me, I'm still working with buyers to try to use a down payment assistance program. I think I may have spoken with you about before that is one that doesn't require repayment. It is a grant. Right. And so literally it's like the borrower has it. They just make 6 one-time payments. And then if they want to get out of an FHA and go into a conventional loan, they can, but there is no repayment. There is no second mortgage on the home. They're required to do like a 45-minute counseling, which really they can do online.
Yes,
it's $75. Yeah, and the lender gives them the credit back for the $75. So, it's a good program.
Okay, let's continue to talk some programs. We got about 4 or 5 minutes left. Popular programs this summer?
The down payment assistance, and then for people who are wanting to do investment property, we now have 2 lenders that are offering 15% down for investor properties, which is, kind of unheard of. And even with one of the lenders with that 15% down, only 5% needs to be your own funds. You can get a gift for the additional 10%.
Wow, that sounds awesome.
Yeah.
No,
and you even with that, you have an option or an interest only. If you're trying to keep the payment down.
Right.
Obviously, you can choose anywhere from a prepayment penalty, depending on the state, from 12 months to, up to 5 years. Obviously, the higher the prepayment penalty, the lower the rate. But it is a good way for people to start getting into the investment market.
What is a low rate today in terms of any of these loan programs?
I think I priced out an FHA loan at 6.875.
Okay.
On a 30-year fix.
Sure.
And then for a conventional, it's about 7.25. And then for the investor loans, those are always going to be a little bit higher, but we can get those down to about 9.25.
Now, do you think the market is finally adjusted to the higher prices? I mean, is the 3% mortgage a distant memory for most people now?
I think it probably is.
Yeah,
I don't,
so do I.
I don't feel like people want it, to be higher, but I don't really believe that if someone is truly interested in trying to purchase, that it's going to stop them. They're just going to try to find another way to be able to, adjust to it, to be able to do what it is that they want to do.
Yeah, I know. I tell people, I say, it's really not about the rate. Can you make the monthly and obviously hope that rates will come down? They will at some point. It's just a matter of when and how much money you've already spent in the interest rate on the loan that you currently have. If it's 5 to 7 years, you may want to think about doing it. But if it's less than that, well, if rates drop by a point, it might be worth it.
True. Very true.
Okay, so prognostications, where are we heading for the rest of the summer?
Well, I think we just said Feds are going to raise the rate, so I think we're going to be dealing with that. But my hope is that we'll start seeing even more property out on the market for people to purchase. And like I said, I still think, you have a lot of people who are interested in doing investor loans. And I am getting more people asking, about, like I said, the program that's stated income verified asset for a primary and secondary home.
And that's, you're saying, is a 20% down type loan?
That is a 20% down loan
Right.
if you're going to do a purchase, and the entire 20% can be a gift.
Oh.
You can also do a cash out refi, and you're required to have reserves of 18 months, but the cash out that you take
Could add
can be
into the
considered-
reserves.
Well, that's considered the reserves.
Now, how does the reserve work? Is it an honor system? Okay, you have the money in the bank today. Does that mean when we close, you're going to keep the money there? How does that work?
Well, I mean, the lender looks at it as if you've taken out enough cash to cover 18 months, there's no reason for you to not be able to pay it, but they have no way of verifying it once you actually
Right.
close on the loan.
Yeah.
But
yeah.
at least, there's a leg to stand on in the fact that you had this money to be able to make your mortgage payment. And I think in most cases, people are just using that type of loan as sort of a patch. Maybe they need it for right now, and they anticipate that in the next year or so, they'll probably be getting into another market or back into a market that they're used to working in, and so there'll be more of an opportunity to verify their full amount of their income and maybe even making more. And at that point, they
Right.
might decide they want to refinance. So it helps people not get completely kicked out of the market who need to be able to do something with a primary or secondary home.
Okay, excellent. Jennifer, thanks very much for coming on. We're at the end of our time. Could you let people know how they might be able to get in touch with you for a terrific loan
absolutely.
officer in many states?
My number is 773-593-6831, or they can call the office for me.
Excellent. Thank you very, very much. I really appreciate you coming on the show.
Thank you for having me, Jeff.
Thank you very much. That's Jennifer Conrad from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. You can listen to us any number of different ways. You can go to themortgagevoice.com. You can go to KCAA, which is our parent and mother station out there in the Inland Empire, and I want to say hi to everybody in the Inland Empire. Love these people, buyers, sellers, people who want information about the loans. Rancho Santa Fe, that's down in San Diego. Rancho Santa Margarita, Riverside, San Bernardino. We reach some parts of LA County, Orange County. Anyway, KCAA brings us a great signal, and we've had loyal listening audience for, the past 8 or 9 years from them. I want to thank them very much. Also, we are also on a number of podcasts. Daryl, do we have a list of those podcasts?
I sure do, Jeff.
Great.
We've got Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and TheMortgageVoice.com.
Excellent. Podclips.io. If you want a centralized place where you can meet all of your podcasting needs, this is a great place to go, Podclips.io. It is, finance and health and lifestyle and sports and all kinds of different things from people you may have never heard of but are really smart and know what they're talking about. Podclips.io. Go there. I'm Jeff Barton. This is The Mortgage Voice. Thank you very much for tuning in. Okay, let's get to the main topic that I wanted to talk about in this particular segment. Okay, and why is it relevant to you to talk about the country of China and what's going on in their property sector? Two things about that. The first thing is the property sector in China today mirrors what happened in the U.S. in 2007, 2008. It mirrors it, but it's not precisely the same. Overbuilt properties on speculation drove the market to ruin in 2007, 2008 in the U.S., and we had what is called the Great Recession. Was it a depression? Nobody knows what to call these things, but they have to tag it with something. What's going on in China is something that has been 20 years in the making. When the leadership in China decided to take half the population out of poverty and move it into the middle class, huge undertaking. They deserve tremendous amount of credit for the success they've had to be able to do that. Problem is that in so doing, they created this real estate nightmare that's going on currently. Now, we've talked about it here on this show many times, about how the property sector in China fueled economic growth in China for, as I said, 20 years, lifting 400 million people out of poverty, yes. But what happened is the speculation in order to be able to build those units is all based on, can you build it? Can you sell it? And will the market be able to sustain the type of growth, 10 to 15% that they were achieving during the boom years? The answer obviously is no. And one of the problems right now is you have debt that has been accumulated not only by companies like Evergrande, who we've talked about it, and by the way, Evergrande's 2-year debt that they have, what does it say? The loss for the last 2 years is $81 billion. This is a company that's still around. They are one of the leading home builders in China. Evergrande, as we talked about 6 months ago, even a year ago, defaulted on their particular debt. Now, what does that mean when you default on a debt? We talk about it in the U.S. just recently when we were talking about the national debt and defaulting on the national debt. Came up with a debt plan, it was signed, it was averted once again. It says that, hey, this is what I'm going to do. I'm going to borrow money from you, I'm going to build something over here, and over time, I'm going to pay you back this amount of money. Now, debt vehicles in the U.S. are pretty straightforward. Treasury bills are what we sell on the open market to the world to fund our trillion dollar deficit. That's what it is in the U.S. And we're kicking that can down the road, which will come one day to fruition in terms of, who's going to pay the bill and what's going to happen. Anyway, the large companies, and there are many of them in China, doing home building, ran into a problem of nobody was buying, can't pay the debt, insolvency. It's all fine and good, except in China, you don't have a free market system. You have a market-directed system by the Politburo or the central government. And because of the fact that you don't have forces that say, hey, maybe the best thing to do is to have these people default, because in China, default would mean that this middle class that you've created, which now has economic power, will begin to hold their money and not spend it. If they do that, just like in the U.S., you're going to have a recession, you're going to have a depression, and then you got real problems. So in this menage of issues going on in China, and let's just chronicle some of them, right, for you right now. There's the property sector. There's Sunac, there's Kaisei, there's Sino Ocean Group, there's Greenland Holdings. All of these companies, and there's 30 to 40 of them, that are all defaulting on their debt right now because the scam was they were making buyers pay for mortgages on properties that were yet built. Now, can you imagine selling that to a U.S. buyer? Now, I know putting deposits down on new homes that haven't been built is one thing, but you're having people pay on a monthly basis on a mortgage that they're getting for a property that's not yet built. And because of the debt problem, they are not being built today. So the Chinese buyer said, I'm not buying. I'm not paying anymore. Real problem. The issue for all this is, what does a centrally run government do in a situation? Well, they've put huge pressure on local governments, local banks, people who are in the local markets where these particular, for instance, this Evergrande, 600 buildings, 600 projects. Now, a project for this company could be, 5,000 units. So you can imagine, this is just one company. But they're all having to rely on local participation by the lenders in those particular provinces. On Monday, this is what happened Monday of this week. Chinese lenders, stock index down 14% from year high in May. That's a huge deal. Imagine if your stock or whatever you're invested in went down 14% in a day, you'd be looking at the window, right? Okay. Then the government came out and said, the central government, the Politburo said, we will support whatever is necessary to prop up the property sector. On Tuesday, stock went up 14%, went down 14% on Monday, went up 14% on Tuesday. Country Garden, which is the largest home builder in China, their stock rose 18% after the government said they were going to step in. Now, the government has been fueling China's economic growth for 20 years. It's only now that it has come to somebody to pay. Now, I worry about war because anytime there's a domestic issue, and I don't care whether you're a free market system or whether you're Politburo controlled, distracting the locals with foreign war, and in China, it's not even that foreign. It's across a small strait, and it's Taiwan. So this is the time where the U.S., China need to get together and be able to provide answers to both Chinese problem about what's happening in their home sector and security for Taiwan in this age of uncertainty that we're all dealing with. Okay, now why does that affect you? I got a minute. Why does that affect you as the home buyer here in the U.S.? Well, the main thing here is to look at what would happen if there's a shot at Taiwan from China. You would see massive real estate holdings, massive real estate decrease in value, drying up of credit. You would see unemployment, all because the Chinese economy, the U.S. economy, is what props the world. These two things. Even though we've seen deglobalization, it's really de-Chinaization, right? Where they're onshoring different manufacturing processes to closer to U.S. It's still the dominant player in U.S. import-exports. These are issues that affect us all. Pay attention. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.